Welcome to Quartic. My name is Nicholas Blaine, Chief Executive. We're going to go through a course introducing you to accounting concepts. Now, accounting, as you're going to discover, or as you already have discovered, is extremely important in the world of finance. It helps you to understand what companies are doing, what businesses are up to, and the knowledge that you gain learning about the basics of accounting you will find extremely useful in a wide range of areas. So this course covers the building blocks for financial statement analysis. What are we going to go through? We've got 7 sections here. Basic introduction, saying what are the main financial statements. We'll look at the main concepts of how the statements fit together. We'll look at much more detail then what the different numbers within each of the main statements say. Then we're going to do a worked example. We'll see a company called Boscombe, and they sell ice cream, so we'll see how we build up a set of financial statements from scratch. We're going to do some ratio analysis, which allows us to compare how one company is doing against another, or how a company is doing against what it was doing last year. And then we're going to look at management choices, which is the beginning of a big discussion on what is it that management are trying to get the accounts to show, and what maybe do we as analysts want to try and understand from the accounts a bit behind the picture. And then we will draw to a conclusion. So it's quite a broad course. Hopefully by the end of this, we're going to have a good understanding of what makes up the accounts and how we can understand them a bit. So we're going to begin. We've got a bit of a route map here. So you can see section 1, introduction. What is accounting all about? What are the accounts? And then we'll introduce the 3 main components of the financial statements. So why are we doing this course in the first place? You need to learn about accounting. It could be you're thinking of doing another accounting course, things like ACCA. You're doing an analyst's course like the Investment Management Certificate or the Chartered Financial Analyst Program. You see financial numbers in your day-to-day life. So just it could be for professional reasons or even personal reasons. You want to understand how to analyze some shares for your own portfolio, or you're thinking of moving into finance, and this is the first step on deciding whether it's a good move for you. So all sorts of different reasons behind why you're watching this in the first place. What you're going to get from the course, we're going to give you a decent understanding of what the accounts are about. So first of all, why they're produced, who produces them, who they're produced for, what the main components are, so the 3 main statements, how they interact. So we're going to see the balance sheet, the income statement, and the cash flow statement. How we can interpret some of the main numbers, and as I said before, the choices that managers make when they're putting the numbers together, and effectively we need to try and get behind the numbers. The way I like to see this is uncooking the books. We're trying to get behind the numbers. Let's begin with the who, when, why, and what. First of all, who prepares accounts? Well, every company needs to prepare accounts. So let's just think about this. It's a very large number of organizations. In the UK, there are around 2 million companies. Some of them are tiny. They may have no transactions. They may just sit there dormant. Other companies are very big and active. They may run a bank or a high street supermarket. Every company needs to produce a set of accounts, but other organizations produce accounts too. You can have associations and partnerships and government bodies, so there are a very wide range of accounts. We're mostly going to focus on company accounts, and as I said, there are 2 million of them in the UK, so a very large number. Who is responsible? It's the company directors. Now, often the directors will pay the accountant to produce them. So it may be a delegated job, but the company's directors are absolutely responsible for producing accounts. If the accounts are not produced one year, it'll be the directors who are hauled up in front of the judge, not any other employee. So that's the who. When are they produced? They're produced every financial year. Now, once every accounting period. When we say accounting period, that typically means once a year. You can have longer and shorter accounting periods, but generally they're 1 year long. Also, we usually talk about a financial year ending on the 31st of December in terms of textbook examples. Companies can have a financial year ending any day of the year, so 365 choices. Now, every accounting period, let's call it an accounting year to keep it simple. The organization, let's call it a company, needs to produce accounts. And they're going to be at the end of each year, and the accounts will show the financial status at the year end and a view of what's happened during that accounting period. Now, a lot of companies will produce accounts more than once a year. So, for example, if you are a company listed on a stock exchange, you have shareholders that want to know more about what the company is doing. So you can't wait a whole year. They will produce interim accounts. In the US, companies often produce quarterly accounts, so every 3 months. So when they need to be produced is primarily once a year, though that could be longer or shorter, and there could be interim accounts as well. Why are they needed? What do they show? They're going to show a lot of information about the financial status of a business and what it's done during the year. Now, why are they needed? This is produced by the directors, as we saw, for the shareholders as a group. Now, we can talk about the legalities of this. The strict rule is that the directors are producing the accounts for the shareholders as a single group. But when you think about it, there are lots of other organizations, lots of other parties, lots of other individuals who want to have a look at the accounts, who may be interested in the information that the accounts contain. So the accounts contain all sorts of information, what the company's got, all the assets they've got, what profit and revenue they've made, even what the directors earn. There's a lot of information in there. So who is going to be interested in this? It's not just the shareholders. It could be potential investors. It could be the employees. It could be the government that want to know if they're paying enough tax. It could be customers who are thinking of buying the product from a company and want to know if they're going to be around in a few years' time. It could be a supplier that's delivering goods to the company and want to know if they're going to be paid. So these are all what are called stakeholders. So stakeholders are any organization or individual that has an interest in the well-being of the company. So lots of different parties there. Now, finally, the what, and this is a very big question because this is going to take up the rest of this course. So what is in the accounts? We're looking at the financial status of the company, what it's done over the last accounting period. So you've got 3 main components. You've got the balance sheet. That is the statement of financial position. On this date, on the 31st of December last year, this is what the company had. This was the position of the company. So that's the balance sheet. You'll see what's called the balance sheet shortly. What has happened during the year? We have the statement of revenues, expenditure, and profit. This is the income statement. What sales did the company generate? What costs did they incur? And take one from the other, you end up with the profit figure. So what profit did they make for the year? And that's what's called the income statement. Now, similar to the income statement, but using a purely cash basis, is the cash flow statement. So the cash flow statement doesn't say what revenue did the company generate, but what cash did the company receive. It doesn't say what expenses did the company incur. It says what expenses did the company pay. And there's a subtle difference. So let's say we make a sale right at the end of the year, but we give the customer some credit. We may generate the revenue and have expenses that we're going to show in the income statement, but if we didn't receive the cash, then we're not going to be showing it in the cash flow statement. So there's a difference, and we're going to become hopefully very familiar with the distinction between those two. So the income statement shows revenues and expenses incurred by the company. We'll talk about the accrual concept shortly. The cash flow statement said literally what cash came in, what cash went out. And alongside those 3 main statements, there are lots of notes, lots of explanations and detailed schedules. Some sets of financial statements extend to hundreds and hundreds of pages long. There's the story that in the UK, the Royal Mail were told not to deliver the printed accounts for the bank HSBC to their shareholders because they didn't fit through the letterbox. So sometimes accounts can be literally 500 pages long. Now these days, of course, most of them are online. Some of the bigger companies will produce big glossy books containing the accounts, but it's the legal statements. The legal requirement is normally a fairly small fraction of what's actually published if they're going to publish a rather large, thick book. So those are the main 3 statements and lots of notes, and we're going to get a little feel for what type of thing may be in those notes as we progress. Let's look at the timeline. This gives us an idea of how the 3 statements fit together. So you've got, on this timeline, 20x1, 20x2. Note the x1 bit and the x2 bit. What that means, it's an accounting wheeze, if you like. What this does is X1 is generic. What it basically means, year 1, year 2. So is 20X1, is it 2001? Is it 2011? Is it 2021? And it allows the just an accounting example to be much more generic. So X1, X2, it's year 1, year 2. So let's have a look at this. The balance sheet is produced on a particular day. The last day of a financial accounting period, there will be a balance sheet produced. In this case, 31st of December 2000 X1 and 31st December X2. Those will be two separate balance sheets. They're on a date. They are the financial position at a particular date. The income statement and cash flow statement both represent what's happened during an accounting period. So the income statement, revenue, expenditure during the whole of the year 20X1, cash flow statement, cash receipts, cash payments during 20X1 or 20X2, and you will see that they are produced once every year. You can see here there's a slight color scheme. If you look, you've got a darker blue for X1, a lighter blue for X2, but you can see that the income statement and the cash flow statement both span an accounting period. The balance sheet is on a particular date, so on the 31st of December at the year end. As I said, it doesn't need to be 31st of December, but for most examples, we're going to stick with that because it makes life a bit easier to try and visualize.